Stocks you must buy in 2023. We're almost done with the tense year that was 2022 for stocks. Inflation reached new highs, interest rates followed suit, and equities took a beating somewhere in the middle. As of November 7th, the S&P 500 was down 20% year to date. The DOW was down 10% since the beginning of 2022, and the Nasdaq was down 33%. As a result, it is becoming increasingly more work for investors to make sense of the markets and identify stocks that can help them sustain, let alone grow, their returns. We have yet to determine when this transition will occur. However, planning for it is still a good idea, especially since the valuations of so many companies with solid long-term stories have plummeted, and some players have exciting catalysts on the horizon. So as we near the end of 2022, let's look at the top stocks to buy before the new year. Here we go. Carnival. Carnival is the riskiest bet among others. However, it's a good stock to consider if you're willing to take some risk. Carnival's cruise operations were halted due to the pandemic. As a result, the company's earnings fell and its debt increased. Carnival is still dealing with these issues today, but some bright spots give us reason to believe in the long-term story. Carnival's adjusted earnings before interest, tax, and depreciation and amortization turned positive for the first time since its ships resumed sailing in the most recent earnings report. Revenue increased by 80% over the previous quarter, and booking volumes surpassed the highs of 2019. Carnival is also taking steps to reduce costs and increase revenue. One of these efforts is to replace small ships in the fleet with larger, more efficient ships. Carnival is currently trading at 1.6 times its normal sales. That is less than 3 times the level of sales prior to the pandemic. Carnival's earnings situation has changed significantly since then, but if Carnival progresses towards profitability and debt reduction, the stock could rise from current levels, meaning a buy could be a winning move. CostCo. CostCo shares have outperformed the market this year. However, they've only lost about 9%, meaning they're less expensive in terms of projected earnings than they were earlier in the year. Another reason to shop at Costco right now: today's economic woes actually benefit Costco. The company sells items in bulk at rock-bottom prices, so as shoppers watch their spending this holiday season, they may prefer shopping at Costco and taking advantage of their membership. Costco charges an annual fee to shop there. As a result, it is in your best interest to do as much of your shopping there as possible. Aside from the difficult economic times, this annual fee is critical to Costco's success. This is due to the company's high profit margin on membership fees. They do not include major costs associated with actual merchandise, such as transportation and storage. Costco's most expensive membership level, executive membership for $120 a year, is expanding, and it now accounts for nearly 72% of sales. That's a promising sign for Costco's future. Vertex Pharmaceuticals. This year, Vertex Pharmaceuticals is a stock market winner. The stock has increased by 38%, but Vertex may be just getting started. This is due to the company being at a critical juncture. The biotech firm is already a market leader in cystic fibrosis treatment. The CF portfolio generates billions of dollars in revenue and profit each year. However, Vertex is about to enter another significant treatment area. Vertex and its partner CRISPR Therapeutics are submitting their candidate for the blood disorders beta thalassemia and sickle cell diseases to regulators in the United States, Europe, and the United Kingdom this month. If everything goes as planned, the product could be available soon, and as a result, Vertex has a clear catalyst ahead of it. Other potentially significant products in Vertex's pipeline include pain management and type 1 diabetes candidates. So Vertex will continue to be a CF leader in a few years, but it may also carve out significant revenue opportunities in other markets. That is why investing early in this innovative biotech player is advantageous. Teladoc Health. Teladoc Health has dropped 63% this year. In addition, the telemedicine leader disappointed investors with $2 billion in non-cash goodwill impairment charges. The heightened investors' concerns about the company's inability to generate profits. But Teladoc's worst days may be behind it. Teladoc reduced its net loss in the third quarter, while revenue and visits to the company have remained in the double digits. And according to Teladoc, the average deal size today is about 50% larger than it was a year ago. Companies that have been hampered by the current economic decline and coronavirus, disruptions have taken on longer than expected to finalize their Teladoc plans. However, these are only temporary problems. When the situation improves, Teladoc could see a significant rebound. As of now, the company has increased the number of US members and revenue per member from quarter to quarter. Teladoc shares are currently trading at 2.3 times normal sales. This is nearly their lowest level ever by this metric. But given the prospects for growth, now may be a very good time to invest in this recovery story. Block Inc. Block Inc. is a worldwide leader in financial technology solutions. Businesses and consumers can use the company's products and services to make and receive payments, store and spend money, and access credit. In the payments industry, it has a significant competitive advantage. The Square platform is one of the most popular point-of-sale systems for small businesses in the United States. It also has a competitive advantage in the financial services industry, due to the fact that its Cash App is one of the most popular payment apps in the United States. In addition, the company is well capitalized and has a strong balance sheet. The company has $563 million in free cash flows to fund its growth initiatives and is ranked highly among stocks that will double in 2023. Amazon. Amazon is a market leader in two markets expected to grow by double digits this decade: e-commerce and cloud computing. Over time, these businesses have assisted Amazon in growing its earnings into billions of dollars. However, today's higher inflation and other issues such as supply chain issues have been weighing on Amazon. As a result, Amazon's operating income has decreased, and free cash flows turned negative. In the short term, this is excruciating. This year, the stock has dropped nearly 40%. The good news is that the long-term outlook remains positive. Amazon has the market position and financial resources to make it through these difficult times. The company's revenue is still increasing, and Prime members are increasingly spending more money on Amazon. Amazon is also improving its cost structure, which will be beneficial in the long run. Amazon shares are currently trading near their all-time low in relation to sales over the last 6 years. As a result, Amazon shares may be the best deal this holiday season. What do you think of these stocks to buy in 2023? Let us know in the comments below and subscribe for more. Thanks for watching.